Every country on Earth owes money. Not just small nations. Not just unstable economies. Even the richest superpowers borrow trillions just to keep operating. And here's the question almost nobody asks. If every country is in debt, who actually owns the debt? Because if governments are borrowing, someone must be lending. And if someone is lending to entire nations, that means someone sits quietly above the system, collecting interest while the world keeps working to repay it. We're told debt is normal, necessary. Governments need loans for roads, healthcare, defense, infrastructure. Borrowing is presented as responsible management. But what if debt isn't just a tool? What if it's the foundation? What if global debt isn't a side effect of the system, but the system itself? To understand this, we have to go back to a time before modern banking. Centuries ago, kings funded wars and projects through taxes or conquest. If they ran out of money, their power collapsed. War was risky because you could actually go broke. There was a hard limit. Then governments discovered something revolutionary. They could borrow. Private lenders would provide money up front in exchange for repayment with interest. It seemed like a win-win. Governments got immediate funding. Lenders got predictable returns. This was the birth of sovereign debt. But that small innovation changed the balance of power forever. Because once governments depended on lenders, moneylenders began influencing governance. The real transformation came with the rise of central banking systems. These institutions didn't just store money, they managed currency and credit. And gradually, money itself became tied to lending. Instead of printing currency freely, money entered circulation as loans. In other words, money was born as debt. Think about that. For new money to exist, someone has to borrow it first. This creates a powerful feedback loop. Governments borrow to fund budgets. Businesses borrow to expand. Citizens borrow to buy homes, cars, education. Growth becomes dependent on borrowing. And once growth depends on debt, the system cannot slow down. During industrialization and global wars, borrowing exploded. Nations issued bonds, promises to repay investors with interest. These bonds became some of the safest assets in the world. Entire financial markets grew around buying and selling government debt. Over time, something subtle happened. Countries stopped aiming to eliminate debt. Instead, they rolled it over. Old debt was replaced with new debt. Borrowing became permanent. Debt was no longer a temporary solution. It became structural. Then came the defining shift of the 20th century. Money was detached from physical limits like gold. Once currencies were no longer tied to tangible reserves, money supply could expand far more easily through credit creation. That meant debt could expand almost without limit. And it did. Today, global debt, government, corporate, and household combined sits at levels so high that repayment in full is mathematically unrealistic. Many governments don't reduce debt. They manage it. Some even borrow money just to pay interest on previous loans. This is the debt machine. And here's where ownership becomes clearer. Government bonds are held by massive institutional investors. Pension funds, central banks, asset managers, and financial institutions. These entities don't run countries politically. But through interest rates and bond markets, they influence financial conditions worldwide. When borrowing costs rise, economies slow. When rates fall, borrowing accelerates. Entire nations adjust policy based on bond market reactions. Governments appear powerful, but they operate inside financial constraints set by debt markets. Attempts to fix the system often deepen it. Printing money can reduce short-term pressure, but risks inflation. Raising taxes slows growth. Cutting spending creates unrest. Borrowing more only postpones the problem. Every solution feeds the same machine. And because modern economies depend on continuous borrowing, stopping the cycle abruptly could trigger collapse. Markets, pensions, banks, employment, all interconnected through debt. Look at recent financial crises. The pattern repeats. Debt rises during boom times. Asset prices inflate. Then something breaks. Rising interest rates, slowing growth, market panic. Governments intervene, inject liquidity, and restart borrowing. Each cycle ends with more debt than before. But here, as the uncomfortable truth, there is no secret room with a single mastermind controlling everything. The real power lies in the structure itself, a network of financial institutions, policies, and incentives that reinforce debt expansion. Every major player benefits from stability. And stability depends on continued borrowing. Modern money and modern debt are inseparable. Most currency exists because someone borrowed it. The largest holders of government debt shape financial gravity through markets, not speeches. And history shows that systems built on expanding debt eventually face turning points. Sometimes they restructure. Sometimes they inflate away obligations. Sometimes they collapse and reinvent themselves. The real question isn't whether the debt machine will change. It's when. Because when a system that powerful shifts, it doesn't just affect governments. It reshapes savings, investments, jobs, currencies, entire generations. And the hidden owners of the world's debt machine. They may not rule the world in secret, but they own the interest on it.